Hello, ladies and gentlemen. My name is Greg Michaelowski from ForexLive.com. This is a weekend Forex report for the week starting August 29th, 2022. In this report, I'm going to take a look at Chair Powell's speech on Friday at Jackson Hole Symposium, dig into that, what it says, what it means, and also take a look at the technicals that are driving the Forex market versus the US dollar. So sit back, enjoy, and be sure to tell me if you like it or you don't. For those who had not read Adam's Forex Wrap on Friday, after this video, please go back and do so. It's important. Friday was an important day, and he summarized in a way that makes him a master of what he does. In rereading the words of the 8-minute speech from Chair Powell on Friday, it was a what I call a come to Jesus moment for the chair, for the Fed, and as well as us as well. Fed and the Fed chair has lost credibility with its "we will be there and come to the rescue in times of trouble," and perhaps from being more broad-brushed versus firm and to the point. And we have become used to that. The first paragraph in his speech, however, set the tone when he said, "Today my remarks will be shorter, my focus narrower, and my message more direct." A major change was underway. He then resorted to what gets people's attention, what sells, and that's fear. He said, "Price stability serves as the bedrock for our economy. Without price stability, the economy does not work for anyone." Notice he said, not a few, not most, but anyone. In other words, everyone. He continued by throwing out more fear with a sprinkling of reality as well. He said that the medicine to bring price stability would likely require a sustained period of below-trend growth, softening of labor, and with it, pain to some households and businesses, but said the alternative would mean far greater pain. People fear pain, but we all experience pain. However, we also have the ability to limit pain. Looking at it another way, the Fed chair is defining risk and then laying the plan to limit risk. For those of you who listen to this preacher, that's me, or read my book, traders need to define risk, limit risk, and the third step is to accept risk. That third part is doing the trade, and by accepting the risk, it is a way to get rid of fear, as fear is everyone's worst enemy. The chair's defining of risk is from his saying, without price stability, the economy does not work for anyone. With the medicine, the risk will be limited to some below-trend growth, some softening of labor market conditions, and some pain, but the pain is limited. So what is the medicine that will limit the risk? Restoring price stability will require maintaining a restrictive policy stance for some time. He then reminded and educated many who were not born until after the 70s and 80s, and also us old folk who have not had to deal with inflation for the last 30 or 40 years, that stopping prematurely is not an option. He even used the word lesson, and he had 3, to purposely tell all these students out there, that's us, that the Fed is the teacher, the mentor, and the buck stops here, God, and is the way, the truth, and the light. The first lesson is that the Fed can and should deliver low and stable inflation. They are the God. They need to take responsibility for it. In fact, it is unconditional responsibility. He did not make excuses that it is a supply thing that's out of their control, but said that the Fed needs to bring demand down to supply. The second lesson is that the public's expectations about future inflation can play an important role in setting the path of inflation. public's expectations of inflation is the devil, the fire-breathing dragon, the antagonists. He cited Volcker when Volcker said, "Inflation feeds in part on itself, so that grip of inflationary expectations must be broken." Powell then cited Greenspan on the concept of rational inattention, where when inflation is low, like it has been for the last 25, 30 years, there is no reason to care about it. He warned that that is not the case now. Inflation is in everyone's attention. In other words, the devil is permeating our minds, our talk, our lives, and that needs to be stopped. The lesson is another fear tactic that lays the pipe for the Fed slaying the dragon, having good conquer evil. If it does not happen soon, the tilt of balance shifts the other way. The third lesson is this is a war. The Fed will not stop until the war is won. The Fed is all in. So this was a come-to-Jesus moment for Fed chair, for the Fed members, for the markets? Maybe. The Fed has defined the risk, looks to limit the risk, and from the speech is accepting the risk, which means higher rates and higher rates for a longer period of time until the dragon/devil is dead. But time will still tell how much pain there will be in the meantime. The Fed has the main responsibility, but there is a lot of balls in the air and responsibilities outside of the Fed, including businesses and governments too. Of course, how markets react will be an influence. The Fed's main tool is interest rates. Rates will be higher for longer, which should be supportive of the US dollar, but other countries are slaying the dragon as well. Stocks will have winners and losers, but higher rates can hurt the more leveraged. There is going to be demand destruction and pain. It will just be more limited. All of which leads us to the technicals, which I will cover next. All right, now that I've given you a little bit of a fundamental background, taking a look at the Jackson Hole Symposium, taking a look at Chair Powell's speech and what that means going forward, it does mean that the Fed is going to be tighter for longer, and that and could tighten more than what the market expects going forward if growth continues the way it has been and things don't slow down. But the Fed is intent on hurting demand. So, and the way they're going to do that is by raising interest rates. That should support the dollar. But again, we have currencies, markets live in a global. It's one currency versus another, and as a result, other countries, other central banks are also working to slow their inflation as well. So there could be times where the dollar gets weaker over time, and that's where technicals come into play, because we have to pay attention to what the price action is telling us. Price action tells us what the market is thinking, what the market is interpreting at the moment. And we saw on Friday that the dollar moved to high levels against most of the major currencies, at least on the day, maybe not for the week, but we did close near the high levels for the day on Friday. And I thought I would start off by taking a look at the euro versus US dollar, what last week's price action told us and what we might expect going forward. So taking a look at the daily chart here, what is of interest to me is that the high price on Friday, which was after the PCE data, the better than expected PCE data, remember, the price came up to test this old, the low of this swing area. Let me get back here. This swing area had a bottom through here between par 96 or 1.0096 and 1.0121, and the high price that we saw on Friday reached a high of 1.0089, about 7 pips short of the low of that swing area through here. And so sellers were leaning against what was an old floor through here, and that's always a good sign. It became a ceiling, and that ceiling held the resistance before moving back to the downside off the Powell comments. Now, drilling down to the hourly chart, the Powell comments sent the price obviously sharply to the downside, and we saw the price move below the 200-hour moving average and stay below that level. And we also saw the price move below this this level at par 32. Which was the high price from Thursday, and stay below the level as well. On the way to the downside, we did come back down, all the way down to test the 100-hour moving average at 0.99639. We, of course, got below the parity level as well. But and the price is closing just below that hourly moving average level. And so we can come into the new trading week. We have a decision to make already. The barometer is either going to be to the upside or the downside for this pair against the 100-hour moving average. But if we do get a rally, then we would expect to see some sellers against the 200-hour moving average here, despite the fact that it broke above that level. The inability to get back above the par 96 level keeps the bears more firmly in control, and I expect sellers against that level on the downside. The low prices from last week took the price to a new low for the year, new low going back 20 years, as a matter of fact. The low price reached 98.99, just let's call it 99, 0.99 level. We had a higher low at 98.089. If we break below the 100-hour moving average and get below our lows from Friday and Thursday through here, those would be the targets on the downside for the euro versus US dollar. And you have to go, to the monthly chart and go all the way back to 2002 to where the levels are, the next low levels are, and looking at that, you have to go down to lows of 96.62. We had a low here of 93.24. So there's a lot of room to roam down through here, but the bears are in control. The bears are in control, and until the price is able to get above things like the par 96 level or moves above the 200-hour moving average at par 35 as a closer level, the sellers are going to remain in control for the euro versus US dollar. So just keep that in mind. Let's take a look at the dollar versus yen. And if we take a look at the price action for the dollar versus yen, up and down this week, we saw the price initially move higher on Monday, down on Tuesday, up on Wednesday, down on Thursday, up on Friday. So it really did the sawtooth pattern here for that currency pair. Now we did close above the June high here. That June high came in at 137, so that's somewhat positive, I guess, for the pair going into the new trading week, at least on a daily chart. We are well or not, a couple hundred pips or maybe a little bit less than that away from the high price that we saw in the month of July, which reached up to 139.38. So there's room to roam on the top side on the daily chart, at least for the dollar versus yen. Of significance, just longer term from a perspective of the bias goes, is that the corrective move here, this is the biggest correction after the trend-like move through here that saw the price unrelentingly move to the upside. The move to the downside here did stall near the 100-day moving average, just this blue line in this chart, and this low right here stalled against the swing area through here where we had a swing high. So that gives the bias, obviously, more of a bullish bias. The fact that we stayed above the old high from earlier this month in August, this week at 135.55 is a positive. We're going to need to get below that level to give, on the daily chart, to give a little bit more of a bearish bias here. This is what it looks like on the hourly chart this week. Lots of ups and downs. The low price that we did see here and here did stall against swing levels through here, which is a good sign. We also stalled against the near the 200-hour moving average. It's a green line in this chart. This is off the PCE data. So the dollar was going down quickly here, but then rebounded back higher, and really held the good support here against the low that we saw on Wednesday. On Tuesday, we did dip lower through here, but bring your attention to this area right here between the 135.29 and 135.59 or 57 level, and the market fell well short of that on the dip to the downside on Tuesday, only reaching a low of 135.81, which is sort of near this consolidation here through this day right here. So buyers are in firm control on the dollar versus yen as well. The 100-hour moving average might be a close support level for traders, intraday traders, short-term traders. Stay above that is more bullish. The 200-hour moving average, a rising 200-hour moving average, is a more conservative stop or bias shifting level that if we move below, it would increase the bearish bias, but as long as we stay above that level, the bulls remain in control. Let's take a look at the sterling versus US dollar. We'll start by looking at the daily chart. And like the dollar versus yen, sort of a sawtooth up and down pattern that we saw in trading here this week, with the price trading near the lows and near the lowest level going back to 2020. The low price off of the low price in 2020 off of the COVID shutdown moved all the way down to 114.08. So there is room to roam. We're only at 130, 117.30. About 40-45 currently at the moment. So there is room to roam to go on the downside. But for the sterling versus U.S. dollar, we're closing or trading below the 118.06 level, which was a swing low through here, swing low through here. We traded above and below that area, this yellow area here this week, admittedly. So the market, the market is sort of saying it was unsure coming into the Fed chair's speech, but we are closing below that area, and that gives it a more bearish bias. If we take a look at the hourly chart, what is significant here is that the price high again off the PCE on Friday did extend above the 200-hour moving average. That was the first time since this day right here, where again we had a quick break to the upside and then rotation back to the downside. Same thing happened here. Quick break to the upside, rotation back to the downside, get below the 100-hour moving average, get below these swing areas through here. Bias remains to the downside this week. As long as the price remains below the 100-hour moving average, the sellers are in control, folks. Let's just keep it as simple as that. If you want to be more conservative in your position for the sterling versus US dollar, it would take a move above the 200-hour moving average to increase the bullish bias, give the buyers some victories from a technical perspective. Absent that, and they're not winning, so the pound remains the focus to the downside for that currency pair. Let's take a look at the dollar versus Swiss and bring attention to this blue line on the daily chart. This blue line represents the 100-day moving average, and over the month of August we've seen a number of different times where the price moved above the blue line, and in trading this past week we actually saw it move above, I think, 4 of the 5 trading days. So or trade above and below it 4 of the 5 trading days. In Friday's trade, we did close just below the moving average level, and I think every other day we closed below we close above it here. But for the most part, the market has been moving above the 100-day moving average, but each time through here, there has been a bit of a failure above that moving average line. So in the new trading week, if the dollar bulls are to take more control, we need to get and stay above the 100-day moving average, and then we'll start to tackle the high prices that we saw during the week, and hopefully stay above the 100-day moving average. Other support comes against the 100-hour moving average, and like the other currency pairs, the lower 200-hour moving average. And like the other currency pairs, the PCE data on Friday did cause the price to briefly move below the 200-hour moving average, first time since this day right here on August 17th, but the momentum cannot be sustained, and Chair Powell sent the price back to the upside. So watch the 100-hour moving average, watch the 200-hour moving average, which also is within this swing area through here between 95.91 and 96.04. If you're a longer-term bull trader, it would have to get below this level to increase the bearish bias, give the sellers some more control. Take a look at the dollar versus Canada. The daily chart remains very choppy, so I'm going to swing right over to the hourly chart. And what we saw on the hourly chart, despite the swinging ups and downs that we've seen through this pair, is that the low price here this week did stall within a swing area and right around the 50%, in fact right at, if not a pip or so away from the 50% retracement of this move to the upside. So we have swing highs, swing highs, swing high, swing low, swing high, swing high, high, swing lows, swing lows. You get the point. This is a demand area, a support area, and it also corresponds with the 50% retracement right near 128.947. We went down to that level on Thursday, and then on the PCE data, we went down and tested it again here on Friday before shooting to the upside. What very close support coming into the new day is going to be this into the new week is 1.30175. That was a swing high here and a swing high here. We'll just assume that the market is paying attention to that level. Other levels come down through here at 129.84 to 129.89, and really the 100-hour moving average at 129.742. We try to move it above here and here on Wednesday's trade, and earlier this week we were above it before moving back to the downside, but momentum cannot be sustained. If we stay above the 100-hour moving average, the buyers are in control. If we move below it, then buyers start to lose control. Getting below the 200 would be another indication of sellers taking more control. Until then, until the price starts to move below these levels, the buyers remain in control for the dollar versus Canada. Take a look at the Aussie versus US dollar. Again, lots of we tried to rally into the data, into the Fed chair speech. PCA data sent the daily chart price to the highest level since August 17th, or a week or so, but fell short of the 100-day moving average. The price is closing near the low for the day, but not near the low for the week. The lows for the week did come down to this swing area here. We had a swing low in May, swing low in June. This was a swing low for June. In early July, we broke below that level and traded toward the lower extreme for the year and multi-year year low before breaking back up to the upside in July. And in trading this week, we went back down to those old swing low levels. So on the downside, folks, if the price is able, the price target on the downside would be toward the 68.24 to 49 level or 50 level. Get below that level, increases the bearish bias, puts us in the extremes for the year for the Aussie versus US dollar. Taking a look at the hourly chart for trading clues. Note here that the 100 and 200-hour moving average are pretty much darn near converged. That convergence comes near 69.28, 25 to 28. And that will be our close barometer for bullish above, bearish below in the new trading week. It's just above this swing area here as well, between 69.11 and 69.19. So all this area right here is going to be upside resistance on any sort of move to the upside, and it would take a move above all that to increase or take some control away from the sellers. Other than that, the sellers remain in control with our swing lows here, 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 all through here, here. All these swing lows are going to be targets to get to and through. And if we get to and through those levels, that's where we start to move into the extremes through here, and look for lower levels in the Aussie versus US dollar. Finally, we'll take a look at the New Zealand versus US dollar from our major currency pairs, and what we can see here is similar price action to the Aussie versus US dollar. But notice the high price on Friday did not make a new high for the week, unlike those other currency pairs who made extremes off of the PCE data. It may give the New Zealand versus US dollar a little bit more bearish bias here. 61.84 to 62.12 are the levels on the daily chart there for that currency pair. And what we can say as to why the price did not go any higher on Friday was it ran into its 200-hour moving average, and traders did find sellers against that level here before moving to the downside back below the 200-hour moving average, back below this swing area, which will be close resistance in trading coming into the new trading week between 61.55 and 61.66. Swing low, swing low, swing low, swing low, swing low. All the swing lows through here. Here is going to keep the pressure on. Now we are coming into a area here where we had some swing lows between 61.23 and 61.31. Get below that level opens the door into our extremes for the month of July. We'll see how that all plays out, but the sellers remain in control. So overall, all our currency markets are showing dollar strength, a dollar bias toward the dollar as opposed to the currencies. So be aware of that. There are technical levels that if the price were to extend in the other direction in favor of the currency, then we're prepared for that. That's what all we can do as a trader is prepare for where the bias shifts, and then believe it and trust it and maybe adjust to it. Quickly, we'll take a look at the U.S. stock indices. They all closed fairly bearish. We'll start off by the Dow Industrial Average. Closed at the lowest level going back to this day right here, which is July 28th. We also fell back below its 100-day moving average. This is a daily chart. That's more bearish for the Dow 30 stock. The S&P index also closed below its 100-day moving average at 40.73, currently trading at 40.57.66, so that's where it closed on Friday. So a stay below the 100-day moving average is more bearish. Remember, last week I talked about how the 200-hour moving average stalled the rally last week, and that a lot of times leads to some shifting of the bias, and indeed it did. Saw the price again extend below the 100-day moving average. For the NASDAQ index, we closed the day at 12141.71. That did close just above the 100-day moving average at 12131, about 10 points above that level is where the close is. Traders will be watching that 12131.59 level on Monday. If we open and trade below that level, that would be more bearish for the NASDAQ index as well. As far as interest rates go, the 10-year yield, recall from our report last week, moved above its 100-day moving average, and we stayed above that level, although we're off the highs for the week. The high yield for the week reached 3.128, currently trading at 3.043. So off of that level, despite the Fed chair's hawkish tone. But the 2-year yield is a different story. That's trading up near its high yields from June, not backing off. And this is the high for the cycle for the 2-year note. So we're getting a flatter yield curve with the 2-year and the shorter end, seeing the biggest gains across that across the debt instruments. Finally, take a look at oil prices. What is interesting here from the oil chart is that the high prices on Thursday and on Wednesday went up to test the 50% midpoint of the move up from the December to March high, and also tested the 200-day moving average near the same level at 95.94. Folks, if the price moves above 95.94, that would be more bullish on that chart. So there you have it, the technical look at the markets. Hope you enjoyed it. Hope you enjoyed my fundamental view and the technical view, and you're prepared for the new trading week. My name is Greg Michalowski. Good fortune with your trading. We'll talk to you on Monday. Bye-bye.